Hi, I'm Jenna Nees, and I'm the Purdue Extension Ag and Natural Resources Educator in Putnam County, and I'm here to talk to you about technical analysis. At the lowest form, technical analysis is the use of historical price charts to predict short-term direction of prices within a commodity market. It is based around the theory that prices move in trends and that history repeats itself. During this video, we would like to introduce you to a few of the basic trends and patterns utilized when doing technical analysis. Now again, technical analysis uses bar charts to determine trends, reversals, resistance, and support in prices. Each of these events suggests that the direction that the market is going to head in terms of the price. Now, not everyone uses technical analysis. Some individuals choose just to base their decisions on the fundamentals, so the supply and demand for a given commodity market. And that's perfectly fine. Now, a lot of the brokers and speculators, though, may choose to utilize some technical analysis when making their decisions and combine that with what fundamentals they know. And that's fine also. However, since there is a lot of brokers and speculators that could possibly make decisions based on technical analysis, it's probably good for some of our producers to have just the basic understanding of what technical analysis is. And so that's why I want to take a few minutes to introduce you to those 4 basic events that we can see in technical analysis. And the first one we're going to look at is resistance. Now, resistance appears when supply is abundant enough to prevent the price from continuing to increase. So its price keeps moving up and down, and hitting this certain level of resistance. And it's signified by that price moving up and down and hitting that wall. And in our chart that we have here, we have our resistance level marked in brown. As you can see, the price keeps coming and going, and it hits that resistance 4 different times. Resistance is finally over once prices rise above that level, and it signifies then that prices have decided to change and are going upward. The opposite happens with support. This appears when demand is strong enough to prevent the price from continuing to fall. So again, the price continually rises and falls to a specific level. That specific level is where the support line is drawn. In the chart here, it's, again, that brown line that we have labeled support. That support line is not broken until price falls below it, and it signifies that prices are in a decline and we need to be leery of it. Now that we've talked about resistance and support, let's move on to trends. Trends signify a pattern that has developed in prices over a specific time period. They can either be short-term or long-term. Short-term trends are typically about 3 months long, whereas long-term trends run from about 6 months to a year in length. And trends are just kind of a straight line that is drawn on the bar chart that connects 2 or more tops or bottoms, depending on what type of trend it is. The more time that prices hit that line that's drawn, the more valid that trend can be. So let's look at an uptrend. Uptrends are drawn at the bottom of the prices, and it signifies that prices are going upward, that we're going to see an increase in prices. And that price pattern isn't broken until prices fall below that trend line that we have drawn. And that signifies then that there's a greater chance that prices are going to decrease. In the chart that we have here, we have our trend line, our uptrend line, drawn in brown, and it's connecting at points A and B. If it was connected at points C and D too, then we would say that's a really valid trend. But even just connecting at A and B, it's still pretty valid. The prices then break from the trend and fall below it, signifying now that prices are starting to decrease and that we probably wish we would have sold when prices were higher. In comparison, we have downtrends, and they are drawn at the top of our pricing line and is done by connecting those high points. And it shows that prices are going downward and that they are decreasing. So we're really happy when we see a breakout from a downtrend, because that means prices are moving up and we're going to see or hopefully receive higher prices. So in the chart shown here, our downtrend is connected at points A and B, And then we've also labeled our breakout point, where prices have started to rise above it. And that's kind of nice because we always want higher prices. So now that we've taken a look at our trends, we're going to take some time to look at reversals. A reversal is a pattern that suggests that the direction the commodity market is going may change. So that means that it's going to go from higher prices to lower prices, or lower prices to higher prices. And this is usually the result of some changes in supply or demand. So it could be that we've had a lot of supply, so our demand is low and prices are going to go down, or that, supply is kind of tight and demand's high, so prices are going to start to rise. Some common signs for reversals are rounding tops, rounding bottoms, double tops, or double bottoms. So let's look at those rounding tops and bottoms. So they appear as a gradual shift in supply and demand. So it doesn't happen really quick. It takes a few days or even weeks or months to actually form one. And a rounding top would signify that prices stand a greater chance of decreasing. In comparison, a rounding bottom would signify that prices stand a greater chance of increasing. And it's just a gradual change, and just like we show here in our chart, we have a rounding top. So it's marked in our brown line, and that we can see that prices have gradually increased, and then now we're starting to fall down. And it signifies that prices are in a decline. Now let's look at those double tops and double bottoms. Double tops are when prices rise, then fall, then rise and fall again. And as they fall, they always stop at a specific point that's called our support line. Kind of like what we talked about earlier. Now as we get that rise, and fall, we form an M pattern. And it signifies that prices stand a greater chance of decreasing. In comparison, our double bottoms are when prices fall, then rise, then fall, then rise to a specific point. And it makes the appearance of a W. And it signifies that prices stand a greater chance of increasing. So if we look at our chart here, we have a double top. And you can see our M pattern, and I've got the support line drawn here. So once our double top actually breaks that support line, we really have that confirmation that prices are starting to decline, and we probably wish we would have sold earlier. But this gives you an idea of what to look for a double top and another form of technical analysis. Now with technical analysis, I've tried to show you a few of the basic things to look for, but there's a lot of other forms of technical analysis that can be very complicated. And that's why technical analysis may not be something for everyone. Some of those more complicated parts of technical analysis is moving averages, stochastics, and relative strength indicators. So for most people, they don't necessarily rely just on technical analysis. You really need to look at technical analysis if you are comfortable and combine that with your knowledge of supply and demand or our fundamentals to make a decision on what you're going to do with your marketing strategies. Remember, part of the reason no one relies solely on technical analysis is because it's very subjective. If we handed 4 people the same bar chart and said draw trend lines, we're probably going to get 4 different sets of trends. Some people are going to have short trends, some may show long trends, and some may not see a trend at all. So again, it's very subjective, and it's up to you to only use technical analysis if you feel comfortable or if you just want to have some fun. So I hope that I've kind of given you a little bit of information to know what technical analysis is and can decide whether or not you want to use it a little bit when trying to develop your marketing strategy. Thank you.